So you're ready to save and invest in your future. You might have opened up a taxable brokerage account, a traditional IRA or 401k, and you have a Roth IRA. Well, now what? What do you invest in and where? There are two strategies that you need to think about to help in determining how you invest the dollars in each of those accounts: asset allocation and asset location. The situation that I just described is fairly common amongst the younger generation that is now making enough money to start investing. Asset allocation and asset location are important to think through, as this can have a sizable impact to your net worth in the long run. Asset allocation involves dividing your investments among different assets such as stocks, bonds, and cash. The asset allocation decision is a personal one and will change over time as your life changes, depending upon how long you have to invest and your ability to tolerate risk. If you are young and have several years before retirement, you can take on a slightly more aggressive portfolio compared to an individual that is closing in on retirement and should reduce risk. For most young professionals, you'll deploy a portfolio that has mostly stocks, therefore an 80-20 portfolio as an example. This would mean that 80% of your portfolio will be in stocks, while 20% of your portfolio is in fixed income. As you near retirement, the portfolio should reduce risk by lowering the stock percentage and increasing the fixed income. Therefore, a portfolio near retirement could be 60% in stocks and 40% in fixed income. Whatever asset allocation you go with, apply it to your overall portfolio. It's extremely important to stay disciplined to your desired allocation and don't try to time the market. And lastly, rebalance the portfolio when asset classes stray from their tolerance bands. Asset location refers to where you strategically keep the money you're investing between tax advantage, tax-free, and taxable accounts in order to maximize after-tax returns. Assets that have a greater potential for growth should be located in your tax-free accounts, such as your Roth IRA. Therefore, an example would be investing your Roth account with a heavier percentage of growth stocks, as these have a potential for higher returns compared to other asset classes. Your tax-deferred account, such as your traditional IRA or 401k, is a great account to keep income-producing investments, such as bonds or even dividend-paying stocks. Bonds will continually produce interest, which would be taxed in your taxable account. However, we can defer that tax payment by keeping in the IRA or 401k. Lastly, in your taxable brokerage account, which is an account where you pay taxes on any interest, dividends, or capital gains that are realized in that current year. The goal with this account is to keep assets where we can manage the tax in this account. We will pick and choose when we realize gains and losses. We can opt to sell a stock at a gain and pay taxes based on short-term or long-term rates, but we can also offset those gains through tax loss harvesting. Asset allocation and asset location are two great strategies that can help increase your net worth if applied to your portfolio. If you need assistance with financial plans, including portfolio management, give us a call at Wealth Dimensions.